Yes, hello guys, Olariwaju, aka Larry, and I'm also known as the Eminent Trader. And this class is a summary of most of the things that you've learned during the course of this class and a prerequisite into what you are going into, especially with the free signals. I'll be talking about the risk management aspects and what you should expect. So during the course of the class, I believe we already talked about what Forex trading entails, trading the currency pairs, synthetic indices. We went through the basic technical analysis that you need for the remainder of this program. And that is I believe you covered your support, your resistance, your trend line, other blocks, some chart patterns and the likes. And also I'll be adding other I'll be adding links to other sets of videos on advanced technical analysis for further study. That is another class entirely. However, I'll be giving you guys for free, so you can actually go through it and study on your own. But if I'm going to come back for questions on that, that is a different class and mentorship entirely. But I'll give you the videos and materials for free for further study. That is that. Then the crypto trading class, so I'll drop the link to that after this session. From as you enter into the next project, which is the 1 month free signals, I want you to note some important things. If you have your pen, you can get it and note it down. There are very important things that you need to know, especially in trading, the do's, the don'ts, and everything. So those are some of the things I just want to add to all that you've learned, so far. So first of all, in trading generally, there is no 100% win rate. There is nobody in this life, there is no trader in this life that has 100% win rate. If any trader tells you that he has 100% win rate and he does not lose, please run, oh, carry your slippers, carry everything and just run, because that person is about to scam you. There is no 100% win rate in trading. Ask any profitable trader, any big profitable trader will tell you there is no 100% win rate. You will lose. Losses is 100% sure. It is the surest thing in the market. Losses is the surest thing in the market. You will lose. No matter how good your analysis is, no matter how good your strategy is, you will lose. It is not your daddy that owns the market. Not be your papa get market. You will lose. And best believe that it is that trade that you are 100% sure about that will break your heart the most. It is that one that you are pretty sure that this thing will go to profit. It is that one, that trade that will break your heart and even shatter it to pieces. So there is no short trade in trading. There is no short trades. There is no 100% win rate. There is nobody that can boast of 100% win rate, because it is impossible. It is impossible to have a 100% win rate in trading. Put that at the back of your mind. So as you funded your account, whether you're planning to fund, whether you have funded your account, bear it in mind that you will lose. You will lose. It is impossible. It is impossible for you not to lose. I'm making sure that I record this class so that you can watch it and listen again. You will lose, oh. You cannot escape losses. The more you try to escape it, the more you tend to lose more. So you can't avoid it. So that's another thing that you should put at the back of your mind. You cannot avoid losses. This is because losses are inevitable in trading. They are part of the market. Losses are even surer than your win. So as you are entering every trade, know that this trade has 80% chance of losing and 20% chance of winning. Remember, the market is not your daddy's own. So there's nothing like this trade is sure. Every trade you are entering, you have 80% chance of losing it and 20% chances of winning that trade. That is one mindset that will keep you in the that will keep you in the game long term. Ask every profitable trader. They embrace losses. They will tell you you can't avoid it. It is only those who are trying to promote something. Maybe they want to promote their signal group, or maybe they want to promote their courses or mentorship, that they will tell you we always win. It is impossible. Even in my signal groups, there are losses. I used to post it. There are losses. Losses are inevitable. They are part of the game. The only thing is that you can win 70, you can have 70%, 60%, 80% win rates, but 100% is impossible. But where most traders mess up is the fact that if your losses are more than your profits, that is when there is a problem. And that is where risk management comes in. And for me, let me get my water. I forgot to carry it before I started this. Yes, I'm back. So as I was saying, You cannot avoid losses. You have to embrace it and know that as I'm entering this trade, it is no longer in my hand. For every trade you enter, once you press that buy or sell button, it is no longer in your hand. It is now left to the market to do its own. So that is where risk management now comes in. Can you afford to lose that risk in that trade? Please off your mic. Oh, please off your mic or mute your mic rather. So as I was saying, as you're entering a trade, you should have for every capital. No, let me even start from the beginning. Once you put your money in a trading account, you need to have your risk appetite. How much can you afford to lose? How much loss can your mind carry that you won't feel it? So this is the main reason why I decided to take this session to cover risk management. So let's get into it. Let's get into it. So for example, now let's say your capital is $10. What's it? So let's say your capital is $10. How do you manage this $10? And also, as you are coming into trading, please do not have this flipping mindset. Flipping strategy is not something that works 100%. Before you can flip an account, you lose. People that flip, they lose a lot. They only post the one that wins. And this is how they do it. If a trader wants to flip, so let me explain that part. So I'm trying to cover so many things in very short time, but let me explain that flipping part that you normally see people do. Every trader that wants to flip does not put all his capital at once trying to flip. So this is what they do. If a trader can afford $100 or has $100 to play with, what it does is that he splits the $100 into 5 places or 10. So if he has $100 to play with, he splits it to 10. So now he has $10 in 10 places. So he tries flipping multiple times before he gets it. If he gets it the first time, he's lucky. After that first time, he might try it 8 to 9 more times and lose $10 each on those 9 attempts. They will not tell you this, but that is how they flip. They won't tell you. So they don't put all their capital at once trying to flip it. So you that your old portfolio is $20, you shouldn't try to flip like those people that can easily put in another $20 if this flipping that they tried, if it fails. Hope you are getting me now. So if you are coming in with the flipping mentality with your old portfolio, you will do giveaway for the market. You just dash derive your capital. So I would advise you, don't come into the market with a flipping strategy mentality. Flipping is for professionals, not just professionals alone, people that can also afford to lose that money they are trying to flip. That's why you see some people, they can do 100 to 2K. But before they did that 100 to 2K, they've lost like $500 or $800 or $1,000 trying to achieve that 100 to 2K dollars. Most people do not achieve it at once. They will not tell you that. They do not achieve flipping at once. For every flip account that you see, best believe that there are a lot of failed attempts before that one. So you would never see anybody flip consistently every day, every time. Please mute your. Okay, let me mute it. So you would never see anybody flip. You never see anybody flip consistently. You never see anybody flip consistently for. So you never see anybody flip consistently for how would I put it now? You never see anybody flip consistently for 10 days or 10 times back to back or 5 times back to back. The most you will see is 2 times or 3 times. So it is very, very hard. It is very, very, very hard to flip. It is very, very hard to flip account. It is not for babies. It is not for babies. Flipping is not for babies at all. Flipping is not for babies. So please don't come into trading with that flipping mentality. You would lose a lot. It is not for newbies. It is after you've gotten your edge and you've mastered it. It is after you've gotten your edge and you've mastered it, I can now say, I want to try and flip accounts. So flipping, you can now try it. That is after you already know what you are doing and you can carry the risk. So I believe I've covered the part for flipping. Flipping is not for babies. So that is one thing you should understand. You might get lucky. You might get lucky, but those who flip consistently, they have so many failed attempts. Do you understand? They have so many failed attempts. People who flip consistently. They have so many failed attempts. So that is one thing you should understand when it comes to flipping accounts. So the next one is risk management, which is the main purpose of this class. So let's say you have $10 now. Let's say you have $10. For $10 now, for you to manage your risk properly, so sorry, it is advisable to divide this your capital by 5 to 10. Now, $10 is very small. So if you are dividing it by 10, that means you are risking $1 per trade. You can do that if you are comfortable with it. And you can also divide it by 5 and ensure that your risk per trade is $2. So this is one thing you should put at the back of your mind. There is synthetic indices calculator. If you go to your Play Store or App Store, it is there. Synthetic indices calculator. Synthetic indices calculator. It is on Play Store. It is on App Store. Then that is for synthetic signals or trades. You can calculate before you enter your trades. Just the way Nash Market works for currency pairs, gold, and every Forex pairs and the likes. Just the way Nash Market works for that. Synthetic indices calculator works for synthetic trade, both volatility, boom and crash, jump, step index, everything. You can calculate everything before you enter. So once you calculate with the lowest lot size, you know, for volatility now, every volatility pair or boom and crash or step, they all have their own lowest lot size. So that is one thing you should put at the back of your mind too when trading synthetic indices generally. The lot size varies. So if you are not careful, you might mix it up. For example, now, for boom 1000 and boom 500, the lowest lot size is 0.2. But for boom 300, the lowest lot size is 1 lot size. Do you understand? So if you took a boom 300 trade in the morning at 1 lot size, you know MT5 usually leaves the lot size of the last trade. I don't know why I'm explaining too much, but I feel like you need it as newbies. You know, MT5 will leave your last to use lot size if you want to take another trade. So let's say you took boom 300, which the minimum lot size is 1, and you traded it in the morning. Maybe we now send signal of maybe boom 500 or boom 1000, or you analyzed it yourself. Sure, you get, and they say enter at CMP, and you just rushed and put 1 lot size on boom 500 or boom 1000. You know that you're already carrying ×5 risk of the minimum lot size. So these are some of the mistakes that you need to avoid. So before you enter any trade at all, on any trade, make sure that you look at it very, very well. Make sure you look at it very, very well multiple times before entering, even if the trade is a CMP trade. Make sure you look at it very well. But for most CMP trades, always use the lowest lot size to enter first, then calculate. Do you get? If you know that the lot size, the risk per pip of that pair is not too volatile, use the lowest. But for every CMP trade, always use the lowest lot size to enter first. But for these free signals during this 1 month, we'll try as much as possible to ensure that trades that are dropped are trades that with $10 you can enter those trades. Trades that the lowest lot size, the risk will not be more than $2, $3, or $4 at most, such that everybody will be able to enter the trade. That is one thing that we can try as much as possible to do for you, so that with your $2, you can be able to enter every trade. With a $2 risk per trade, you can take every trade that is dropped. But on my own signals, I'll be dropping currency pairs, most definitely USD and JPY pairs. I will not drop gold because gold is not for small capital. Gold is very, very volatile. Gold is very, 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 very volatile. Do you understand? Gold is very, very volatile. So I'll try as much as possible to only drop currency pairs that you can enter the trade with $1, 1.5, $2, or $3 using the lowest lot size. So that one is settled. So go back to the drawing board, look at your capital very well, and have a maximum risk per trade. If you're, like I said, make sure you are dividing it by 10. Dividing it by 10 makes more sense. That means that you take 10 consecutive losses for you to blow your account, which is almost impossible. It is impossible for us to have 10 consecutive losses. Only if village people is just following this project, which I know that village people are not following it. So make sure you just divide your risk per trade to 10. So if your capital is $50, that means your risk per trade should be $5 or less. So the higher your capital, you can reduce it. So if your capital is, let's say, $100, you can do $5 risk per trade. That means unless you lose 20 consecutive trades before you lose your account. Your capital is $50, you can do $3. So you can do $3 risk per trade. You can do $2 risk per trade, you can do 2.5 with your $50. That means with 2.5 now, that means you can still carry 20 unless you lose 20 consecutive times before you blow your account. If your account is $15, you can do 1.5 or 1. So that means it will take you 10 or 15 trades, 15 losses back to back before you lose your account. Forget about the profits. One thing that I always advise people is capital preservation. It keeps you in the game. There's no need to take stupid risk as a beginner. There's no need to take stupid risk. It is only risk management that will save you from unnecessary losses. And if you build that risk management momentum from now, it will help you a lot in the long run. It will help you a lot in the long run, going into other spaces. Maybe you now get a Profem account and you are now trading a bigger account. Once you know this basic rule of dividing your risk, for example, now if I'm trading a Profem, I know that my overall drawdown is 10%, my daily drawdown is 5%. What I normally do is I divide that 10%. Sometimes I divide it by 30, sometimes I divide it by 20. If I divide it by 30, I just look at it that it will take me 30 trades, 30 losses consecutively to lose my Profem account, or 20 consecutive losses to lose my account. So I risk 0.3 or 0.5. And sometimes I divide it by 4, I risk 0.25 per trade. So if I'm risking 0.25 per trade, it means it will take me 40 consecutive losses to blow that Profem account. So it doesn't matter how long it takes for you to pass the account. But what matters is avoiding blowing that account. But when your risk is low, you get comfortable in taking trades. So if you are trading for, I'm looking at Profem now, if you are trading a Profem account now, and you already know that it will take you 40 consecutive losses before you can blow the account, your mind will be at rest at every trade that you take, because it will still take 39 more trades, 39 more losses before I blow the account. That's if I'm risking 0.25% of the account per trade. 0.25% of the 10K account is $25. And 25 times 40 is 1,000, because maximum drawdown on a $10,000 profit is 1,000. So if I'm risking $25 per trade, it will take me 40 consecutive losses to blow that account. So that's why you rarely see most professional traders blow their account, because they understand risk management. So whether you are trading 1 RR or 1 2 RR or 1 3 RR or 1 4 RR, as long as that minimum risk, you already know that you take me 40 or 20 or 30 trades to blow the account, you get more comfortable. But if you do not have a well-written trading plan or risk, that is when you just trade recklessly. You can risk 1% on one trade, risk 0.5 on another trade, risk 2% on another trade. If you are doing like that, the probability of you being inconsistent, indisciplined, and blowing that account is very, 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 very high. So I am an advocate. I'm an advocate of risk management. I'm an advocate of risk management. Risk management is very, very, very important. It's very, very important. So as we go into the next stage, which is trading the signals, go back to the drawing board. Rather. Write down your capital. Write down your risk per trade. If they drop any signal, yes, my time is almost up. So if they drop any signal, you calculate it first and be like, okay, if the minimum lot size, if the risk is more than your calculated risk per trade, don't take it. You don't have to take every trade. That is one thing you should understand. You don't necessarily have to take every trade. It is not every trade. It is not every trade you have to take. Do you understand? So have a risk appetite. How much can I afford to lose in every trade? If your account is $10, you can comfortably lose $1 on every trade. But if your account is $10 and you're risking $3 or $4, by the time you lose 2 times, you've already blown the account. Do you get the gist now? So even if your account is $100 and you're trying to do $20, by the time you lose 2 or 3 times, $60 have already gone in your account. It's remaining 40. You become scared. And once you become scared, you are bound to make mistakes. Do you understand? So that's why it is important to have a risk per trade that you can comfortably lose. Remember, I already said in the beginning that losses are inevitable. You cannot avoid it. You cannot avoid it. Losses are inevitable. You would always lose. You would always lose. There will be losing trades. But one thing that is certain in trading is that as long as you know what you are doing, there is no way you lose 10 trades back to back. There will be wins, there will be losses. But if you are a bad risk manager, before you get to that 10 trade, your account is already gone. And by that time, it will be too late. You start looking for how to fund your account again. But risk management will save you. And another thing that will help during this signal sending is that it will also help you get familiar with these peers and the market, because most of you have not traded synthetics before. Some of you have not even traded a live account before. So that is why it is important for you to get that synthetic indices calculator and your Nash markets to use together to calculate. But for my own currency peers, just use the lowest lot size. If your capital is $20, sorry, if your capital is $30 or less, use the lowest lot size. I won't drop any currency peer signals that the lowest risk is more than $2. Be rest assured about that one, because I will be dropping a lot of CMP trades. You have to enter immediately, I call it. And if you miss a CMP trade, ask before entering again. Once it has passed like 1 to 2 minutes after I drop it, don't enter unless you ask. Do you understand? Don't enter unless you, and that's another common mistake that most of you will most likely make. Because when they drop a trade at CMP, it means you enter immediately at the market price. That is market execution. So you enter with the lowest lot size. But once it has passed like 1 to 3 minutes after someone drops it, and you see that it has passed 2 3 minutes after the signal was dropped and it is a CMP trade, don't enter again. But if it is a buy stop, sell limits, buy limits, go to your calculator first before placing it. So the calculator will give you the actual lot size for you to use for that trade. Do you understand? I believe you're already clear. My time is almost up. It remains like 3 minutes. So I won't be able to take questions. But if you have any question, you can ask on the group. And I will drop this video. I will drop this video after the class. I'll also drop the crypto trading class. I'll drop the other technical analysis class for further study. But from tomorrow, we will be solely dropping trade signals from tomorrow, expect signals from tomorrow, both in the general group and in the funded traders group. But the funded traders group was created so that we'll be able to monitor your growth and ensure that you don't make mistakes and your account grows. Do you understand? And the general group too, for those in the general group, you can get your demo account of $10,000, get the demo account, and you can also use it to trade and practice pending the time that you get your own, account. I believe this is very, very clear enough. I remain Olanrewaju Kilaribi, or the eminent trader. See you on the other side. Thank you and God bless. Good night.
Follow me for more educative contents like this.